Most beginner investors do not lose money because they are not smart enough. They lose money because they make the same avoidable mistakes over and over again. They buy because of hype. They sell because of fear. They follow random opinions online. They check their portfolio every day. They invest money they might need too soon. And then they wonder why investing feels stressful, confusing, and dangerous. But here is the truth. Investing is risky, but many beginner mistakes make it much riskier than it needs to be. In this video, we are going to break down 7 investing mistakes beginners must avoid. These are the mistakes that can destroy your confidence, damage your long-term progress, and make you quit before compounding ever has a chance to work. And make sure you watch until the end, because mistake number 7 is the one that silently ruins more investors than they realize. Let's get into it. Mistake number 1 is investing without a financial foundation. This is one of the first mistakes beginners make. They hear that investing can build wealth, so they want to start immediately. And that is understandable. Starting early is powerful. But investing before your basic financial life is stable can create serious problems. For example, imagine you invest your money, but then your car breaks down, or you lose income for a month, or an unexpected bill arrives. If you have no emergency fund, you may be forced to sell your investments at the worst possible time. That means you are not really investing with patience. You are putting money at risk that you might need soon. Before investing seriously, beginners should think about 3 things: emergency savings, high-interest debt, and monthly cash flow. You do not need to be perfect, but you need enough stability so that every surprise expense does not force you to panic. A strong foundation gives your investments time to grow. A weak foundation makes you emotional. And emotional investing is where many mistakes begin. Mistake number 2 is chasing hype. This happens when beginners buy something only because everyone is talking about it. A stock is trending. A coin is pumping. A company is all over the news. A video says this is the next big opportunity. And suddenly, it feels like you have to buy now or you will miss your chance forever. That feeling is called FOMO, fear of missing out. And FOMO is dangerous because it makes you act before you think. You stop asking, does this fit my strategy? And you start asking, what if everyone gets rich except me? That is when people buy high. Then, when the hype fades and the price drops, they panic and sell low. The fix is simple. Never invest just because something is popular. Popularity is not a strategy. Before buying anything, ask yourself, do I understand what I am buying? Do I understand the risk? Does this fit my long-term plan? Would I still want this investment if nobody was talking about it? If the answer is no, you are probably not investing. You are reacting. And reacting to hype is one of the fastest ways beginners lose money. Mistake number 3 is trying to time the market perfectly. Beginners often ask, should I invest now? Should I wait for the market to drop? What if I buy today and it crashes tomorrow? What if a better opportunity comes next month? These questions are normal. Nobody wants to invest at the wrong time. But the problem is this. Nobody can consistently predict the perfect moment. Even professionals struggle to do it. If you wait for the perfect time, you may stay on the sidelines for months or years. And while you are waiting, your money is not working. This is why many beginners use a simple method like investing consistently over time. Instead of trying to guess the exact bottom, you invest on a regular schedule. When prices are higher, your money buys less. When prices are lower, your money buys more. Over time, this can reduce the emotional pressure of making one perfect decision. The goal is not perfect timing. The goal is consistent behavior. Because long-term wealth is usually built through repeated smart decisions, not one perfect prediction. Mistake number 4 is putting everything into one investment. This is a classic beginner mistake. Someone becomes convinced that one company, one stock, one coin, or one trend will change their life. So they put too much money into it. First, it feels exciting. If the price goes up, they feel like a genius. But if something goes wrong, the damage can be huge. One company can have bad earnings. One sector can collapse. One trend can disappear. One risky asset can fall faster than expected. And if your entire future depends on that one idea, your portfolio becomes fragile. The solution is diversification. Diversification means spreading your money across different investments instead of relying on one. It does not remove all risk. Nothing does. But it helps reduce the damage if one investment performs badly. For beginners, this is why broad, diversified funds can be useful to understand. They allow you to own many investments at once instead of betting everything on one winner. One investment can disappoint you. A diversified plan is harder to break. Mistake number 5 is ignoring fees. This mistake looks small at first. A 1% fee, a 2% fee, an expensive fund, a hidden cost, a trading fee, a management fee. Beginners often think, it is only a small percentage. But over many years, small fees can become very expensive. Why? Because every dollar you pay in fees is a dollar that cannot compound for you. It is not just money you lose today. It is also future growth you give away. Imagine 2 investors get similar market returns. One pays low fees. The other pays high fees. After 10, 20, or 30 years, the difference can be massive. Not because one investor was lucky, but because one kept more of their returns. This is why beginners should always pay attention to costs. Simple, diversified, low-cost investing is not exciting, but it can be very powerful over time. The less money you lose to unnecessary fees, the more money stays invested for your future. Mistake number 6 is checking your portfolio too often. This sounds harmless. After all, it is your money. You want to know what is happening. But checking too often can make you emotional. One red day can make you nervous. One bad week can make you doubt your entire strategy. One scary headline can make you want to sell. And one big green day can make you overconfident. The more often you check, the more noise you see. And the more noise you see, the more likely you are to make emotional decisions. Long-term investors need perspective. Daily movement is normal. Weekly movement is normal. Market drops are normal. If your plan is long-term, you do not need to react to every short-term movement. A good investing plan should not require you to panic every morning. Set a schedule. Review your portfolio calmly. Focus on your goals. And remember, the market will move. Your emotions do not have to move with it. Mistake number 7 is quitting too early. This is the silent killer. Beginners often start investing with excitement. They watch a few videos. They open an account. They buy their first investment. Then a few months pass. And nothing dramatic happens. Maybe the account is flat. Maybe it is down. Maybe progress feels too slow. So they think, this is not working. Then they stop. But long-term investing is not designed to impress you in the first few months. It is designed to reward consistency over many years. Compounding takes time. First, it looks slow, almost boring. But if you quit too early, you never reach the part where compounding becomes powerful. The biggest results often come later, after you have stayed consistent, after you have reinvested returns, after you have survived market drops, after you have avoided emotional decisions. That is why patience matters so much. Do not confuse slow progress with no progress. And do not quit before your money has enough time to grow. So let's quickly recap the 7 investing mistakes beginners must avoid. Mistake number 1. Investing without a foundation. Mistake number 2. Chasing hype. Mistake number 3. Trying to time the market perfectly. Mistake number 4. Putting everything into one investment. Mistake number 5. Ignoring fees. Mistake number 6. Checking your portfolio too often. And mistake number 7. Quitting too early. Avoiding these mistakes will not make investing risk-free. Nothing can do that, but it can make you more disciplined, more patient, and more prepared. And that is exactly what beginners need. You do not need to be perfect. You just need to avoid the mistakes that destroy most people's progress. Investing is not about being a genius. It is not about predicting every market move. And it is not about getting rich overnight. It is about building good habits, avoiding emotional mistakes, and giving your money time to work. Start with a strong foundation. Keep your strategy simple. Stay diversified. Control your emotions. And keep learning. If this video helped you, hit the like button and subscribe to the channel for more simple videos about investing, money habits, and building long-term wealth. Turn on notifications so you do not miss future videos. And take a look at the other videos on this channel, because they are designed to help beginners understand money step by step. Thanks for watching, and I will see you in the next one.